The prevailing wisdom in global finance is that physical retail is dying, starved out by monolithic e-commerce logistics centers like this one. That narrative completely breaks down in the Philippines. Here, the domestic retail sector is entering an expansionary phase, with the physical market projected to reach a valuation of $118.2 billion by 2026. This divergence is powered by a rapidly growing middle class and a continuous inflow of overseas worker remittances. That capital feeds directly into steady, relentless consumer spending. While traditional investors in the West abandon physical storefronts, the Philippine market has become a unique sanctuary for consumer-driven growth. And that disconnect has created a massive blind spot. Behind this skyline, one specific real estate entity is quietly weaponizing this exact macro tailwind. This 2026 earnings report from Robinsons Land Commercial REIT, or RCR, shows full-year revenues hitting 11.08 billion pesos, a 35% growth, alongside a 41% net income surge. Underlying numbers are even more aggressive. Quarterly revenues jumped 51%, all while operating completely debt-free. Commercial real estate trusts do not typically generate tech-level growth numbers, especially during a global high-interest rate era. These earnings represent the first visible result of a deliberate multi-billion peso wealth-building machine operating right under the market's nose. To understand RCR, you have to look at its parent company, Robinsons Land Corporation. RLC has initiated Vision 2030, a corporate master plan targeting 25 billion pesos in net income, funded by a 125 billion peso capital expenditure war chest. Deploying 125 billion pesos usually means taking on massive amounts of high-interest bank debt, which can easily suffocate a developer's balance sheet. To solve this, RLC utilizes capital recycling. The developer injects mature, income-generating properties into RCR through tax-free property for share swaps. The parent company unlocks immediate cash for high-yield developments. In return, the REIT secures a predictable pipeline of properties that immediately increase shareholder dividends. This symbiotic loop creates a self-funding growth engine, bypassing traditional debt markets entirely. Traditionally, commercial real estate portfolios have anchored themselves to a single asset class, the standard office building. When RCR held its initial public offering, its portfolio was 100% office space. Today, through targeted acquisitions, shopping malls comprise a dominant 53% majority of its footprint. Office buildings rely heavily on fixed rental contracts. In today's economy, that rigid structure makes them highly vulnerable to inflation and the ongoing transition toward hybrid work. Shopping malls utilize a different model, percentage leases. A retailer's rent is tied directly to their actual sales volume. As foot traffic and retail prices rise, tenants generate more revenue. RCR automatically captures a percentage of that upside, creating a built-in inflation hedge. By structuring its revenue around retail spending, RCR evolved from a static landlord collecting flat rent into an active participant in the country's consumer boom. To test the effectiveness of this retail-centric strategy, we have to compare RCR's performance against the established titans of the Philippine REIT sector. Take AREIT. It is a mature, highly respected industry leader, but it currently trades at an expensive premium of 14.1 times earnings, while delivering a negative 1% return over the past 12 months. Then there's MREIT. Its heavy reliance on traditional office properties left it exposed to shifting workspace trends, resulting in a 12.5% earnings contraction and a negative 7.5% return. This chart reveals a glaring discrepancy. RCR is generating the fastest earnings growth in its peer group, yet it trades at a deeply discounted multiple of just 4.52 times earnings. The broader market is paying a premium for stagnant, office-heavy portfolios, while entirely mispricing a highly liquid, fast-growing retail powerhouse. The current portfolio is only part of the equation. The sustainability of this model relies on the parent company's future development pipeline. Robinsons Land Corporation holds over 1.1 million square meters of existing, fully operational mall space ready for potential injection into RCR. RLC is actively deploying 5 billion pesos to expand and upgrade flagship locations, including Robinsons Manila, Bacolod, and Dumaguete, continuously increasing its premium leasable area. RCR doesn't absorb every property. It filters for high-yielding, sponsor-backed assets, a strict quality control mechanism that maintains its 96% blended occupancy rate. This massive inventory of pre-built operational assets guarantees a predictable flow of acquisitions, securing the REIT's dividend growth pipeline for years. We are looking at a commercial real estate trust that operates without debt, posts record-breaking earnings, holds a structural inflation hedge, and still trades at a massive market discount. RCR's 125 billion peso strategy converted it into a debt-free vehicle capable of capturing the highest earnings growth in its market, while others in the sector contract. So, do you see retail properties as the ultimate REIT play, or are you still betting on the recovery of traditional office spaces? As always, this analysis is not financial advice. Do your own research and evaluate the risks before deploying your capital. Let us know your thoughts in the comments below. Like this video, subscribe to the channel, and join us as we continue uncovering the hidden realities of the market.